Welcome to SPAC Chat. I'm Karen Snow, Head of U.S. Listings here at Nasdaq, and it's my great pleasure to be speaking with Tom Hennessy, co-CEO of PropTech Investment Corp. II, and Chris Laurence, CEO of Appreciate. Last month, PTIC announced its upcoming business combination with Appreciate, an investment marketplace and managed services platform for single-family rentals that provides end-to-end solutions for both retail and institutional investors nationwide, and is Hennessy Capital Group's second PropTech-focused business combination. Tom, Chris, we know you're incredibly busy, so thank you so much for the time.
Thanks for having us.
Tom, it would be great for those less familiar if you could articulate for us what makes Hennessy Capital and your PropTech franchise specifically different from other SPACs. And what would you say is your secret sauce?
Sure. Well, Karen, thanks for inviting me to participate in SPAC Chat. I'm pleased to be here with you and your audience. So a little background on our organization. Hennessy Capital Group, we are an alternative investment manager founded in 2013. We invest through two primary strategies, our public equity SPACs and private equity growth. Regarding our SPACs, we have been a pioneer in SPACs since inception. We have raised 10 SPACs totaling approximately $2.5 billion of IPO equity volume. And we pride ourselves in serving as a strategic capital and growth partner for our target companies. We're very proud of our track record of 5 successfully closed business combinations, and we are equally excited about our 6th deal recently announced with Appreciate and Chris here today. So regarding our differentiators, we recognize there are many SPACs out in the market today, but first, to us, it starts with culture, values, and alignment. We employ a partner-centric model, meaning we partner with all stakeholders, including founders, management, employees, directors, and shareholders, to catalyze growth, to help build enduring businesses and iconic brands that make positive contributions. One of the unique features of a SPAC is that you can structure a winning solution for all stakeholders, and we have demonstrated that creativity in structuring each of our business combinations, including with Appreciate. Second, we have a proven track record of navigating complicated SPAC transactions and setting companies up for success in the public capital markets. And what I mean by this is that we provide a company with all the tools and resources to execute on their mission, vision, and growth plan as a publicly listed company. And third and finally, we have relevant domain expertise in real estate technology. We launched the first ever dedicated PropTech SPAC in 2019. Our team is comprised of advisors and board directors who are seasoned executives within PropTech, venture capital, private equity, public M&A, public equity investment, and founder operating know-how. We bring to bear a wide variety of relevant skills, relationships, and know-how for the benefit of our partner companies, in this case with Appreciate.
That's great. Thank you for that. So given all the potential business combinations out there, what was it about Appreciate that you found so attractive?
When we IPO'd our second PropTech SPAC in December of 2020, at that time we promised our investors that we'd bring them a category winner that is innovating in real estate. We firmly believe that we are delivering on that promise with Appreciate. Residential technology has been one of our core investment themes since we launched our series of PropTech SPACs. We were a first mover and on the frontier of residential homeownership technology when we brought Porch Group public in 2020. And again, we are a first mover and we believe we're on the frontier of single family rental or SFR technology with Appreciate. We have spent a considerable amount of time studying SFR because home ownership is becoming increasingly unaffordable. As home prices rise, interest rates rise, and income is not keeping up. Because of the housing affordability issues, demand for single-family rentals has grown tremendously, both necessity-based renters, but also preference-based renters. Institutional investors are recognizing this opportunity within SFR and now have made equity commitments to SFR aggregating over $50 billion, which is up from less than $1 billion of equity commitments 2 years ago. So the SFR supply, on the other hand, is still predominantly fragmented and owned by non-institutional investors, which collectively own around 97 to 98% of the total $4 trillion US SFR market. So we see a massive growth opportunity for institutions to scale into SFR. Currently, institutions only own around 80 billion of SFR housing stock, which again is about 2 to 3% of the overall market. So we believe that institutional ownership could double or triple over the next 3 to 5 years. and there are tremendous macroeconomic tailwinds for Appreciate. Now, specifically on Appreciate, Appreciate is the end-to-end marketplace and management services platform for SFR. We believe that Appreciate is a category winner in this SFR white space, and Appreciate is already attacking the massive and fragmented TAM. Appreciate's asset-light, purpose-built technology marketplace facilitates both frictionless and efficient investment into SFR from retail and institutional investors. We know this because we have evaluated every company and technology in SFR, and we selected Appreciate because Appreciate checks all of our investment criteria. Company has an accomplished leadership team here led by Chris with deep SFR industry expertise. They have a proven revenue model that delivers meaningful financial results and highly scalable unit economics with an LTV to CAC of 13.6 times. Appreciate has multiple levers to drive growth and most importantly, compelling fundamentals. Approximately 50% historical gross margins and growing and already EBITDA break even for the past years. So we believe that Appreciate has attractive fundamentals at the right valuation.
It's an exciting story and certainly the right company for this environment. So Chris, can you walk us through your decision-making process to leverage the SPAC product to access the public markets? And how did you weigh the pros and cons versus a traditional IPO?
We evaluated both a traditional IPO as well as a SPAC merger to get public, but we were eager to get public based on the industry opportunity we see for Appreciate right now. There's been strong growth in key demographic groups for homeowning, including millennials, but there's also been a chronic undersupply of housing. That's unlikely to get better if there's a recession, and higher mortgage rates have made affordability even worse. So these trends are expected to drive growth in our industry. And with the platform we've built, we've got a foundation to scale aggressively. Our opportunities include, growth in our core business, marketing-driven retail customer expansion, momentum-driven institutional expansion, and new market entry. We've also got a big M&A opportunity, rolling up mom and pop managers, rolling up our remaining franchises, and building out our capabilities and offerings through acquisition. We've also got some highly accretive acquisition expansion available to us in new products and services, things like payments, referral opportunities, including mortgage, insurance, and home warranty. So the scale of our growth opportunity suggested to us that a public listing was the best source for capital. And it was a bonus that it'll also raise our profile with institutional and SFR investors and also give us the ability to attract top talent as we grow. While there are pros and cons to each approach, IPO versus SPAC, at the end of the day, we felt that the SPAC path would give us greater certainty. And given what's happened in the market in recent months, I feel good about that decision.
And so mind sharing for other CEOs who are weighing their options, how you went about determining PropTech was the right fit for Appreciate? Sort of what were the key criteria?
Sure. I guess first, our overall mindset was that this was not a company sale transaction. That might sound obvious to your SPAC audience, but I'm not sure it is to every management team. And the implications of knowing that this is more like a financing and not a sale are extensive. One big implication, for example, is that for sure it's not about who gives you the highest valuation. So we were fortunate to have several attractive proposals from SPACs, and we went with PropTech for a few main reasons. First, we've got a great track record. Tom went through the history. It was important for us to partner with someone who wasn't new to the SPAC world and who was known and respected. Second, these guys really know PropTech. They've been around the industry for years. They've talked to dozens, if not hundreds of companies, and they're really expert in our field, and we like that. Lastly, we could tell that Tom, Joe Beck, and the team at PropTech would be good partners. They're straightforward. They stick to what they say. We've worked really well together, and we feel great about this part of the decision in particular.
And Tom, can you talk a little bit about companies that are dual tracking and, a SPAC versus a traditional IPO, and any advice that you have for management teams that are thinking about the SPAC route?
I recommend that management and their board first evaluate all growth alternatives, which should include a SPAC, but also perhaps an IPO, a strategic sale, or private equity buyout. A SPAC is not the right option for all companies, but it could be a compelling option for certain companies. For those that are evaluating a SPAC, I recommend that you first select a SPAC sponsor that will be the right partner for your business. Hopefully that sponsor will have a demonstrable track record of successful business combinations, relevant industry expertise, and an aligned vision for the growth and business plan for your company. After that, I recommend surrounding the deal with the right group of advisors and service providers that will bring the appropriate capital markets, legal, audit, accounting, and tax structuring know-how to help execute the deal in the right way.
I agree with Tom, and I'll also point out, having the SPAC bring those advisors and service providers to the table has been critical for us. I expect it would have taken us much longer to get ready for a traditional IPO without a SPAC partner's expertise, even if the IPO window were open.
So before we sign off, any final words of wisdom from either of you?
We all recognize that it's a challenging capital markets environment and worrisome macroeconomic outlook. There's a great deal of fear and negative sentiment. With that said, I also believe that for certain companies like Appreciate, with solid fundamentals, experienced management team, compelling industry tailwinds, a public listing could catalyze growth and unlock tremendous shareholder value over the long term. So there are still reasons to be optimistic, and we are certainly optimistic about the future of Appreciate.
That's great. Tom, Chris, thank you so much for your time. And on behalf of everyone at Nasdaq, we wish you continued success. And that's it for SPAC Chat. See you next time.